Howdy, everyone. This episode is brought to you by Fireblocks. Love this company. You'll be hearing all about them later from me later in the episode. But now, on with the show. All right, everyone. Welcome back to another roundup edition of On the Margin. Today, we are joined by special guest Jeff Dorman, and of course, my intrepid co-host, Mr. Mark Yusko. What's going on, fellas?
All right. Thanks, Jeff, for joining us. And just to set the tone, I'm in the red room, and I'm sure people have seen the cartoon of The Shining. The guy with the axe with inflation coming after Chairman Powell. And I am wearing, I need the sock cam so I can take it down here. But
we need a sock cam.
Yeah, I know. But we're gonna do this. So I'm wearing the Lord Rothschild pants. So I got the Blood in the Street pants, and I got. I am an outfit repeater. I have the crypto winter, crypto on ice. Look, we are in crypto winter. It ain't going away until spring comes, and people have to get used to it. And I'm getting a lot of hate on Twitter over it, but prepared is better than just saying, "Oh, this is not happening." No, this is happening, and we'll talk about why it's happening, and it's actually going to get way worse.
I'm going to enjoy this conversation then, because I feel the exact opposite. So this will be a good conversation.
Oh, that's great. Okay,
yeah.
Perfect, fellas. All right, so here's I was just telling Jeff and Mark, we prepared this whole slide deck for this. What I wanted to talk about initially was dispersion going on in crypto. Basically, all the charts that I put together yesterday have been invalidated. We're recording this on the morning of Friday, January 21st. Crypto's down 9%, so basically every chart that I put together is wrong. Guys, I just want to get your perspective about what's going on right now. Frankly, so the narrative, just to kind of set things up, right, is that the Fed is beginning to tighten, right? So it's happening on two different accounts. We're now pricing in 100% chance of 4 rate hikes next year. There's a 50% probability that the first rate hike in March is going to be 50 basis points. People are very concerned about that. And perhaps even more concerning is this idea of quantitative tightening, right, which is the Fed not only tapering the purchases on its balance sheet, but actually reducing items on its balance sheet as well. Basically, people are assigning a lot of the turbulence in markets, both in the stock market, right? I don't know if you guys saw Netflix yesterday, but that got pummeled. Peloton got pummeled, down 20, 30%. Mark, we've talked about this before, but basically a lot of the COVID-era darlings have done complete round trips, right, if you look at the charts. So I guess, guys, just talk to me about what you see is going on right now. How related is the turbulence that we're seeing in the stock market and crypto to what's going on with the Fed?
All of it. I mean, totally related. I mean, look, this is all interconnected, right? And it's so funny. I find this really interesting. So, when the Fed was pumping money, I mean, creating just incredible amounts of money. I said it was hard for me. I was in an interview a while ago. I said it's even hard to say out loud that they created 39% of all the dollars in the history of the Republic in 18 months. It's now 50, half the dollars that have ever existed in history have been printed since March of 2020. And so when that was happening, everybody said, "Oh, that's great for Bitcoin. And look how Bitcoin's doing. And look how great it is." Well, now they're talking about taking the punch bowl away. And I actually had people over the last month and people on Twitter try to make it a case that was good for Bitcoin. That tightening and that rising rates were actually good for Bitcoin. It's just nonsense. And so what really is going on now is a combination of so many things, mostly liquidation, right? This is like March of 2020. And it's not so much the liquidation of the levered Bitcoin traders. That happened in November, right? That was the 68 to 48 move. This is actually what happened in March of 2020. This is the liquidated pajama traders, right? We had the highest level of margin debt in history in the stock market. People were borrowing money for free, and they were buying companies like Peloton and Zoom and GameStop. And, I was actually doing my 10 surprises yesterday, Michael. And literally while I'm talking, someone's texting me, "Oh my God, you're saying that Peloton, literally the equity could be zero. It's down 25% right now." I'm like, yeah, it's not me doing that. I didn't know that was happening. But yeah, they have too much debt. People do what they do with exercise machines. They buy one, they ride it for a while, and then it gets sold to play it against sports.
Jeff, what do you think about all this?
I'm still trying to get past the term crypto winter and what that even means. There's so many stale terms in this market, and everything from Bitcoin dominance to altcoin to crypto winter. I mean, if crypto winter is a reference to 2017, there's literally nothing in today's digital asset market that looks anything close to what existed in 2017, except for Bitcoin. Everything else is completely new, completely different, has real revenues.
Well, it's not reference to that at all, Jeff. It's cycles, right? Cycles, like seasons, occur in every market. And winter applies to every market.
So in the last 13 months, there's been 7 drawdowns of more than 20% in the digital asset market. Were each one of those a crypto winter?
No.
So what is the difference?
A winter is a season, okay, like a spring or a summer, and the long-term action of a market where there's accumulation or distribution, and there was when in spring and summer there's accumulation and price rises. In winter, fall and winter, there's distribution and price falls, and we're in a distribution phase, not an accumulation phase, and it's going to get worse as people are forced to sell what they have to sell as opposed to what they want to sell.
Sure. I mean, but okay. So I want to get to the Fed in a second, but before we get there, again, this is the 7th time in the last 13 months that we've had a correction of more than 20% across the digital asset market. If you want to have a better parallel to what's going on, you could go back to April, May, June, July of just last year, right? In April, Bitcoin went down, but the rest of the digital asset market actually went up, right? There was a lot of dispersion. In fact, the whole first 4 months of last year, you had dispersion. January, DeFi rallied. February was mostly about centralized finance, FTT, BNB. March was mostly about social tokens, things like Chili's, Rally, the rest of Web 3.0. And then in April was sort of the laggards that went up, which was your Dogecoins, your legacy Bitcoin Cash and Ethereum Classic and nonsense like that, right? But Bitcoin started going down in April while things were still going up. Then in May, everything caught up and fell together, right? So you started to have the entire market start to go down. Most people kind of saw that coming because there was leverage building. So actively managed funds did a lot better than the broader market. The broader market was down anywhere from 25 to 35% in May. Then in June, we had that capitulation like we're seeing now, June and July, where, I actually wrote a piece back in June talking about debunking all of the bear market theses that existed in digital assets back in June because the market had fallen about 40 or 50% from the highs. And back then, you had, just like today, you had tons of despair, you had liquidations, you had every macro fund calling for the end of the world, and there was 10 or 11 real theses back then about why the digital asset market was going to die. Everything from China is pulling out, to regulatory pressure is coming, to the Fed's going to be tapering soon, to retail momentum is dead, to there's no institutional interest, and ESG is going to kill the market, and MicroStrategy is going to be a forced seller, and the grayscale unlocks are coming. I mean, there was just nonsense after nonsense of digital asset bear theses. If you fast forward to today, you're looking at the exact same pattern, right? In November, Bitcoin fell, but the rest of the market did fine. In December, everything played catch up. The whole market was down 25%, including Bitcoin, but most actively managed funds outperformed because, again, you could see this coming and you had hedges and things like that. And then in January, just like in June and July of last year, now you're seeing that big capitulation where everybody's throwing everything. GMO is out with literally the exact same macro thesis that they put out a year ago when rates rose in the beginning of the year. And then, of course, macro funds got crushed last year as everything reversed. The difference is, unlike in June and July last year where there was 10 or 11 theses for why the market was going to go down, today there's literally only one thesis, and you already said it. It's the Fed. It's the removing of the punch bowl. It's money printer no longer going burr. So we're down to literally one thesis for why every risk asset on the planet is going down. And what I would argue is there's certainly going to be declines in the market. We're seeing one right now. We'll probably see 5 or 6 more throughout the year. What I don't understand is how every single Fed tightening cycle of the last 25 years has been a 3-year process where most risk assets actually do well during the tightening cycle. And it's the end of the tightening cycle where the Fed goes too far, too fast at the end, where you generally see risk assets fall. So what I'm trying to figure out...
We're not in a normal cycle, right? This has nothing to do with normal, right? This is like the end of the 1930s. This has nothing to do with the 70s. It has nothing to do with the 80s or the 90s or the 2000s, right? We've had emergency stimulus measures, right? The loosest stimulus measures, the loosest economic conditions in the history of, again, the Republic. And we've had it for coming up on 10 years. And it's unnecessary. And the problem is, by doing that, you encouraged excessive speculation, excessive borrowing, and you pushed asset prices not to normal levels, right? We have asset prices that, like I said, Peloton yesterday, before it went down 25%, could fall 90% from yesterday's price and still be expensive.
For sure. And this
right?
is not...
And that's the difference, is when you have assets that are selling on average, here's the crazy thing, on average at close to 10 times revenues, that ends badly. The math is horrible for a leveraged economy globally, a leveraged market globally. Again, this is why Bitcoin right now is not the driver, right? All the Bitcoin people want to be the driver. It ain't the driver. It's the tail, and it's getting wagged. And the reason it fell so much overnight, and the reason Michael's charts got blown up, is it had nothing to do with Bitcoin. It has to do with a whole bunch of people got margin calls at 4:01 last night. They had to sell something. Only thing that's open, guess what? You're going to sell your Bitcoin. And
100%. Look, I'm in 100% agreement with you on the overvalued areas of the economy are going to get sold down, right? And what is that, right? We've already seen K-Web fall 50%. That's Chinese, tech ETFs. We've seen things like Arca CIO, which is a bunch of profitless tech companies for sure. You could go down the list and find, 10, 20, 50, 100 different companies that have no revenues, no profits, and are going to get sold in an environment like this. And to your point as well, I think Bitcoin is just an extension of the risk markets, right? I've been writing about this for literally 13 months now about how Bitcoin is really just a 24/7 VIX now, where every single, the flip side of everyone getting excited about institutional interest in Bitcoin is that, well, once you have institutional interest and Bitcoin is the only open 24/7 liquid market, it's going to be treated like a risk on, risk off asset. Now, long term, right, there's a long-term tail where Bitcoin is incredibly valuable because of the protection of purchasing power, and who knows when and if the fiat currency experiment ends, and you're going to want to actually own Bitcoin to spend rather than just to talk about in dollar terms. But in the interim, right, Bitcoin is basically just a binary option where every movement along the day-to-day or the week-to-week to the month-to-month is really just reflecting a probability, either increase or decrease, of hitting one of those two tails, of Bitcoin either being worth zero or Bitcoin being worth $1 million. In the interim, it's just a risk asset traded like the VIX. I get all that. What I don't want to say is that you can put a blanket on that's it for all risk assets because the Fed is raising rates. Because again, this is a 3-year process of removing liquidity. There's a 1.6 trillion of reverse repo. There's more liquidity in the system there. The Fed today is still adding to its balance sheet. It hasn't even started yet. So a correction makes sense. But to act like we're in a 3-year bear market now, or a crypto winter, or even a tech winter because of the Fed, to me doesn't add up, right? If we go down this year, it's not going to be because of the Fed. The Fed is going to be a 3-year process with fits and starts, just like last year when Treasuries went from 90 basis points to 180 basis points in the first 3 months of the year, and every inflation hawk was calling for the end of the world, and every macro fund was selling everything. And what happened? It didn't happen right away. So Treasuries rallied back from 180 to 130. The dollar stopped going up. Equities started going back up. Digital assets went back up. So anyway, I'll just leave it at this. Yeah. Bitcoin 100% right now is going to follow everything that happens with the Fed and with macro. But Bitcoin is not the digital asset market anymore. There are now 4 viable use cases for digital assets, and 3 of them are not affected by what is happening right now. So we can no longer just talk about things like Bitcoin and the market. There are now different distinct parts of the market, and we have to identify that and understand that parts of the market will go up and parts will go down. Now, not necessarily every day, right? You're going to see a leveraged flush once in a while like we're seeing today where there's forced selling. But over 1 month, 3 month, 6 month periods, just like we've seen over the last 2 years, there's going to be massive dispersion in digital assets, just like there is in traditional markets.
I totally agree, and let's level set. Crypto winter doesn't mean end of markets. Crypto winter is a specific term, okay? 4-year cycle. And we can debate whether people still believe in the 4-year cycle. I absolutely believe in the 4-year cycle. It's endemic to the nature of the beast when you have things that have these built-in price adjustments, the halvings. So in a 4-year cycle, you're going to have a winter period, about 18 months, and you're going to have a summer period of about 18 months. Then you're going to have kind of two transitionary periods in between. And that's what I'm talking about. I'm talking about an 18-month period before you get into the next summer leading up to the next halving in 2024. And I actually do think all crypto assets, all digital assets are going to suffer the same fate, because I totally agree, right? And my big thing yesterday was I do these 10 surprises, and my surprise on Bitcoin was that last 2 years my surprise was it's going to do way better than you think. 2 years ago it was Bitcoin is going to go up probably a lot. I didn't think it was going to go up 300% actually, but it's going to go up a lot. Last year it was it's going to go up, but it's not for the reasons you think. It's going to go up because the dollar is going down, that the currency we value it in, right? Because one Bitcoin is one Bitcoin, right? That's incontrovertible. Mm-hmm. But we don't price it in Bitcoin. We don't price things in Bitcoin. We price things in dollars. And so Bitcoin per dollar actually went up because the dollar went down by a lot. So this year I said, look, Bitcoin prices are probably, unfortunately, going to be volatile and probably end the year lower. And nobody wants to hear that. But that has nothing to do with the opportunity. The opportunity is that's so meta in that, the metaverse, which overused term, but the opportunity set for all these other use cases that you talk about, Jeff, is exactly right. But here's the problem. Those assets are even more overvalued than Bitcoin right now. Like way more, because people bought them with no understanding of what they are, whether it's Solana, whether it's Avalanche, two assets that I think are long-term huge home runs. But going from pennies to $250 isn't logical, nor is it sustainable. And those levered speculators in those assets, not the true holders or the people who understand the network or the users, those things are going down.
Can I ask you guys a question just about Bitcoin in general? And there's a whole bunch of concepts that I want to break apart there. But where would you guys say the market thinks Bitcoin is a value buy? Like, do you have an opinion on, is Bitcoin a value buy at 30,000? Is it 40,000? Is it 20,000?
I do.
If you had to guess at where you think the market thinks Bitcoin is a value play at, where would you say that is?
Two different questions, though. What does the market think, and what do we think?
Yeah, okay. Two-part question. What do you think the market thinks it is, and where do you think it is?
Well, I'll go first because I think that is absolutely an impossible question, because there is no such thing as Bitcoin value. To me, that's an oxymoron, right? Bitcoin has, like I said, Bitcoin is a call option. It's either worth zero or it's worth $1 million. And anything that moves along that path is just a difference in probability weightings of whether or not Bitcoin is worthless or whether or not Bitcoin really is, gold 2.0 or some sort of real store of value. So in terms of value buying, the only way to put any sort of a value assessment on there is to do a scenario analysis, right? What is the probability of it going to zero? What is the probability of it going to $1 million? And weight that in terms of what it is worth. So if you have a very high probability of Bitcoin going to $1 million, then, which would put it in the $10-20 trillion, camp, 500,000 to $1 million per coin. If you have a high probability of that and a very low probability of zero, then yeah, anything, below 300,000 is going to be a value buy. But there's no difference to me between 40,000 and 30,000 and 60,000 and 20,000, right? It's all incredibly, incredibly, incredibly cheap relative to the end game if you're right, and it's all incredibly, incredibly expensive relative to the end game if you're wrong and it's worth zero. So to me, Bitcoin, you can't put a value on Bitcoin, right? It is a speculative trading vehicle until it hits one of those two endpoints. The other parts of the digital asset world, which is where I would argue with Mark that there are pockets that are very undervalued, there's other pockets of digital assets where I think the opposite is true. I think it's very easy to put a valuation on certain parts of it because you can actually look at real metrics. So for instance, Mark was talking about Peloton, and there's 20 or 30 other stocks out there that have fallen from, call it 50 to 100 times sales, that are now trading down to 5 or 10 times sales, which are probably still too expensive. But as I mentioned, there are 4 real success stories of blockchain-based assets since inception, right? One is Bitcoin as a potential store of value. 2 is stablecoins, and we've seen 400% growth in stablecoins in the last year alone, from 30 billion to 150 billion. 3 is decentralized finance, right? Everything from insurance to banking, lending, borrowing, trading, exchanges, et cetera. And then 4 is now NFTs and gaming. If you look at all of those, there are real pockets of value and real growth, right? I mean, NFT growth was 8,000% last year in terms of volumes and interest. DeFi exchange trading was up 500% in terms of volumes last year. And you can go down the list. Something like a Nexus Mutual, for example, which is decentralized insurance. Well, here's the value. I'll right here.
No. Tell me where the value is in OpenSea, which is a fantastic business, at $13.5 billion valuation.
Yeah, I don't think there's any value to OpenSea at $13.5 billion. I think that's crazy,
Okay.
right? I mean,
Okay.
but I will say that there is a lot of value in a gaming token that trades at 2 times price to sales with 600% quarter-over-quarter growth and pays a dividend yield, right? Something like Axie Infinity, which even though it's getting crushed, Axie Infinity had a $3 billion run rate revenue a few months ago. Now it's down to about a $400 million run rate revenue, but that's still a $400 million run rate revenue, up from basically zero a year ago, with a 10 times price to sale in a growing industry, with a real treasury that backs you, and you're trading at 2 to 3 times book value. Nexus Mutual is an insurance protocol. Nexus Mutual trades at 65% of book value, meaning if activist investors decided to liquidate Nexus Mutual, you would make 50% just on getting the assets back from the trust. SushiSwap, a decentralized exchange that is growing 500% year over year in terms of volumes, trades at 2 times price to sales and pays a 16% cash dividend. So my point is, yes, there is definitely a lot of overvalued parts of all markets right now, but you can't throw a blanket on it anymore and say it's all going down or it's all going up. And I think that's where I come off being differentiated is, you would never say the ETF market is screwed, it's going down, it's all going down, right? Because inevitably a smart investor will say, well, what do you mean? What part of the ETF market? Do you mean bond ETFs, or do you mean commodity ETFs, or do you mean actively managed ETFs or gold ETFs or healthcare ETFs, right? They all react differently based on what is packaged inside of that ETF, not the ETF itself. And that's where we are with digital assets now, which is the biggest difference between 2022 and 2018, is that in 2018, all of the digital assets looked exactly the same. They were all spin-offs of Bitcoin, right? They were forks of Bitcoin, or they were some unproven protocol. But now you have real sectors and real different token types where you can't say digital assets are going down, because the question would then be, well, what do you mean? Are gaming assets going down, or are DeFi assets going down?
This is great, because if 2 people always have the same opinion, one is unnecessary. So we want to be necessary. And we actually don't disagree. We're actually saying, believe it or not, we're actually saying the same thing, just in a different way. In that, which sounds like an oxymoron. But yes, all assets can and do go down during liquidation phases, right? The value stocks yesterday, oil stocks, right? Oil stocks, particularly the Permian Basin stocks, which are gushing cash for the first time ever in their history, went down yesterday. Why? Because when liquidations happen, you're not able to sell what you want to sell. You sell what you have to sell, right? In March of 2020, what went down? Bonds, gold, and Bitcoin. Mm-hmm. What the hell? No. Stocks are supposed to go. Well, yeah, stocks did go down. And when they went down, the margin calls come. Because the problem isn't the assets. Totally agree with you. Aave, Sushi, incredible long-term buys. Axie, love it, right? Been talking about it for a long time. But that change in run rate does change things particularly quickly.
For sure.
And the momentum around the game itself is waning for lots of different reasons we could talk about. But I still like it, and I still love the model. But the issue is, none of that matters in short-term liquidations, because everything does go down.
Yeah.
The value gets more value. The crazy gets just absolutely decimated and crushed. And that's what you've seen with Zoom and Peloton and all this stuff. And so, look, I am, people say, Mark, you're always so bearish. I am wildly bullish, right? I'm spending my whole life now in the digital asset space, right? I mean, us old macro guys now spending all our time in digital assets. I mean, what the hell? That's an interesting endorsement of the opportunity. But the part that I'm really struggling with here is, back to Michael, your question. I actually will say that you can value any network. Pretty simple, based on Metcalfe's law, and you can look at the number of users, and you can look at the assets that go into a network, And Tim Peterson does the best, and we'll get Tim on the show sometime. And I think that everyone believed that the value number in Bitcoin. I think the market believed that the value number for Bitcoin was in the 40s, high 40s, 45-ish was the number I heard a lot of people throw around. Anything under 45 is a you got to buy it all. And I will argue, no, it's probably closer to 30 if you look at Tim's work and you put the right decay factor in the Metcalfe's law model, you get somewhere in that 30s range. What he used to call the never look back price. And the thing about networks that's really cool is I will argue there is zero probability of Bitcoin going to zero. It is an advance in computer science, right? Today is the 8th anniversary of Mark Andreessen's article in the New York Times, which if you haven't read, everyone should read. It's the 8th anniversary where he said this is one of the most fundamental breakthroughs of computer science we've seen in a generation. And so the likelihood of it going to zero is zero. And I don't think it's a risk asset at all. I think it is the next 5,000 years gold, right? It's digital gold. It is a perfect store of value. It is the future of money. It is the future settlement layer. I mean, one of the problems with fintech, there's no tech. All these fintech companies have been built on old technology, on Swift and all the legacy banking systems. It's all going to migrate into DeFi protocols and onto the Bitcoin blockchain like Lightning. So I actually think that you can value any asset, and I think there's still an air pocket to come for digital assets, mostly because people are going to be forced to sell what they can.
Yep. Guys, I have one more question on the Fed and central banking, and then I want to move into how you see the market playing out for the next year or so. Like, Jeff, maybe we can dive deeper into your dispersion kind of thesis, because I'm inclined to agree with you as well. My one question is, and maybe this kind of flies a little bit in the face of the macro narrative right now, which is central bank tightening and risk assets responding. At the same time that we have the Fed tightening, you actually have the PBOC and other central banks loosening. So the PBOC actually eased monetary conditions, right? Their real estate sector has been absolutely thrashed over the course of the last couple months. Last night, let me just make sure that I have this right, they actually lowered a pair of lending benchmarks, which, when I kind of look at what are the different markets that are involved in crypto, you got to remember this is a global asset class in general, right? I know we all live in the United States and we think it's the center of the world, but in actuality, it is not. And you have a couple of different markets that drive crypto. So do you guys see actions that the PBOC takes in general as being having an impact on what's going on in crypto? And if so, why when the PBOC cuts rates, do we not see, why is that not part of the narrative? Why do we not see crypto respond to that?
Well, I think they are the tail. I think they are the dog wagging the tail. Right? I've been talking about this forever. That we're all arguing in the West how to set up the checkerboard because we want to play a nice game of checkers. They're playing Go. They're playing a totally different game. Their goal over the next 30 years, actually now 29 years, they passed this a year and a half ago, is to become a prosperous socialism economy, okay, which is a translation into dominant world superpower. That's their goal, unabashed. The previous 30 years, the goal was a harmonious rise. Not threatening, nice and easy. K-Web, great example, right? The reason K-Web went down last year isn't because Joe Biden got tough on China, isn't because Trump got tough on China. It's because the PBOC withdrew liquidity from the markets 18 months ahead of everybody else. And the stock market in China went down. And there was it got exacerbated by the fears over the VIE structure and all that stuff. But, one of our big things is this year, right? Chinese tech stocks, K-Web in particular, are going to be the best performing market in the world because, Michael, just as you described, they have reversed the liquidity. Liquidity drives markets. And when you're adding liquidity and you have very cheap assets, the PE, forget price to sales, because most of those companies don't have any earnings. But the PE of Chinese tech stocks is down close to 10, okay? Because they actually have earnings. Tencent has earnings. Baba, one of the best companies on the planet, JD, Meituan, Pinduoduo. I mean, these are real businesses, and they were before yesterday. I didn't see yesterday, but through yesterday, they were actually up year to date. when everything else in the world was down, to exactly your point, Michael.
Yeah, I'd echo that. I mean, I think just because we're not talking about that today because of the fact that digital assets are, the digital asset correlations as well as even like tech correlations, a lot of these are spurious, right? They change quite a bit. I mean, I've been writing about digital assets full time now for 4 years, and like Mark, I've been in this. Mark's been in this market a lot longer than I have, but I've been doing this for 2 decades now. I write everything because it's the only way I can retain and be able to draw back time periods. And I've probably written 13 or 14 different things over 4 years about the correlation of digital assets to something, right? The correlation to the dollar, the correlation to money supply, the correlation to tech stocks, the correlation to gold, right? It changes all the time. In this period right now, for whatever reason, digital assets are an extension of the U.S. equity market, right? Maybe it's because of Asia cracking down on digital assets 6 months ago, and it took a while for everyone to fully leave. But everything from the actual correlation of the instruments to even just the trading volumes, right? The trading volumes in digital assets for the last 2 months spike at the U.S. Open and they spike at the U.S. close. That hasn't always happened, right? So why is that happening, right? Partially, it's because there's a lot more U.S. interest in digital assets relative to other parts of the world than we've seen historically. Part of it is because there's still way more money, over here in the institutional investor world who have been getting involved. Part of it is simply, because the Fed, still has a much bigger reach with regard to global macro investing. But there's no question that what is happening in other parts of the world with more looser monetary conditions and going the other way, like that will have an effect. It might not have an effect today or tomorrow, but that will have an effect. We are not a myopic industry, right? This is a global 24/7 industry for a reason. It might get myopic at certain times, but it rarely holds. So I tend to agree with everything Mark is saying. And I even agree, going back to what we were originally saying about, why we're selling off right now. I guess the difference of opinion I really have is the length of this. I guess when I hear crypto winter, I think 2018, where it takes 18 months to unwind. I think all of these crypto winters are basically 1 to 2 month cycles now, and then you're right back to the races because, again, you have more money coming into the space than we've ever seen. You have fundamentals, whether you're talking about sales or earnings or even just growth metrics like things that you would measure on using Metcalfe's law. They're all still up and to the right, and quite frankly, there's still nowhere else to go. Right at the end of a tightening cycle, you might start to see real rotation into bonds, or you might start to see real rates get positive again. But right now, we are still 24 to 36 months away from there being real viable alternatives to equities and digital assets if you want to generate any sort of a real return. And I just think it's just very premature to think that the end is near simply because of the price action of the last few months. So long story short, I think again, the rest of the world is doing very different things than here in the U.S. And I think that will absolutely matter for digital assets as well as for equities in Asia and beyond.
No, and that's the incredible insight, Michael, that, again, I told you, Jeff and I actually agreed on everything, even though we don't sound like it. That's the incredible insight, right? Which is, yes, the opportunity set is incredibly robust. And what is going to happen is a rotation from these egregiously valued assets, the FANGs and FANG man, right? If you include Microsoft, Apple, and NVIDIA. I mean, owning Apple, a company that is not growing. Oh, they're growing. No. They financially engineer their earnings per share by buying back stock, but their net income is the same as it was 6 years ago. Just a fact. But no one wants to talk about that. They just look at the earnings per share number, and that is financial engineering. And so to pay 30 times earnings for that, stupid. And that will end. And so as people wake up and say, wait a minute, what do you mean Axie, a company that didn't exist 3 years ago, has the same revenue, right, as Fortnite? How is that possible?
I agree with that.
Okay.
Yeah.
And wait a minute, Fortnite, which is run right down the street here at Epic Games, right? They get all the money, whereas the community actually gets a share in the digital asset space in many models, not every model, but in many models, you can actually share. There are actually dividends paid. There are actually share of fees. And so DeFi is a place where I'm wildly bullish, like Jeff, and that is in fact, so wildly bullish that people should listen to this podcast and not that other one that Blockworks does.
I agree. Subpar. We're in competition, Jeff, with Jason's show. We're going to smoke him, though. All right, guys.
Hey, actually, Michael, real quick, can I just comment on what Mark just said here?
Yeah,
absolutely. I think he's hit on something really important here, right? It's like, everybody in the world would agree that Apple has been somewhat of a safe haven for most investors, right? It's in almost every single investor's portfolio in some way, shape, or form. But as Mark is kind of pointing out, at some point that changes where people are like, wait a minute, let me go look back over longer periods of time. And maybe this isn't the safest place to be because we're still getting a much higher growth multiple put on it, even though it's much more of a slower moving value stock now. The same thing is actually happening in digital assets. The players just aren't there yet, right? So in the equity market, for example, and Mark's been allocating to funds for 20 odd years. In the equity market, you have your early stage venture investors. Then you have your mutual funds, long short equity hedge funds, your growth equity funds. Then you have your retail investors, right? In digital assets, we're missing that middle group. We just have the early stage VCs, and then we have the retail investor. The growth equity guys, the guys who value something that trades at 2 or 3 times earnings or has a 10% dividend yield, they largely haven't come to digital assets yet, right? Which is why you get this period where the VCs will buy something early, it runs up, retail will love it for a while, and then it just goes in no man's land for a while. But if you're an actual value investor, and we speak to these institutional investors all the time, we speak to the pensions, the endowments, the private equities, the growth equity guys, the family offices, they're now coming into digital assets, not starting with Bitcoin like they used to, not starting with Ethereum or Solana like they used to. They're asking, where are the yields? Where are the cash flows? Where can I get 10% yield? Where can I see 30 or 50 or 100% quarter over quarter growth that has real revenues and real cash flows? And there's a lot of companies and projects in digital assets that have those characteristics. Those types of investors just haven't quite moved into this market yet, right? When they do, that is, we're talking about hundreds of billions, if not trillions of dollars of new entrants into this market that is going to look at these types of assets as safe havens in the same way that they were looking at, FANG stocks and healthcare stocks and bank stocks over the last, 20, 30, 40 years. So there is going to be that tectonic shift. It might not happen, right now, but it is going to happen. Like that is where the value is in digital assets today.
This episode is brought to you by Fireblocks. I talked to a lot of fast-growing crypto-native funds, crypto banks, exchanges, and the like, and they all tell me they have the same 2 problems. 1, their treasury management setup sucks. They've got analysts wasting time and money on manual transactions. 2, they are not happy with their current security setup. They're sharing passwords, they're sending test transactions, and they're worried that their funds might be at risk. Fireblocks is a platform that solves all of that for you. They are a one-stop shop portal which automatically plugs into exchanges, trading venues, etc. They source deep liquidity and solve everything from day-to-day crypto transactions all the way down to complex DeFi strategy. And the best thing about Fireblocks is that they offer scalable solutions with industry-leading technology. Doesn't matter if you're a 2-person crypto fund or a 2,000-person crypto exchange, these guys have you covered. And the last thing that I'll say about this company is that I have known them for years. They are a high-integrity team. They ship product like no other. I would trust them with my own funds. So, click the link at the bottom of this page and tell them that I sent you. Very, very important that you click the link at the bottom here. Otherwise, they're not going to know that I sent you, and then how am I going to get credit? So help a brother out. Click the link at the bottom of this episode. Tell them I sent you. Yep. So I want to dig into that because, one of the sectors that I want to get both your opinions on is DeFi in general, which I think is a criminally slept on sector right now within crypto. But I want to ask you something first, which is I actually saw, Jeff, you were going back and forth with this guy, Jordy Alexander, on Twitter. We actually just had him on the podcast last week. And I want to talk about the idea of the importance of a strong Bitcoin when it comes to crypto markets in general, right? I know his thesis. I'm going to try to sum up his thesis. He put out a great thread on this. We can link it in the show notes. But it's basically that you need a strong Bitcoin for the rest of crypto as an asset class to actually be strong in general. And he kind of outlines it as there's this game theory idea. There's a tragedy of the commons type thing where basically there's a relationship that first money tends to move into Bitcoin and then but there's an idea that altcoins always do better, right, in bull runs. So you buy Bitcoin first, but then you buy these overly speculative altcoins. And to your point, Jeff, there probably isn't the investor base, right, to support, the next stage, but whatever. And then everyone kind of realizes, like, why am I holding this Bitcoin? Like, I'm just going to go into these altcoins that everyone buys alts, then Bitcoins dip, then the altcoins that are correlated to Bitcoin, they dip even lower. So I'd love to get both of your perspectives on, because I agree. I think a lot of what's driving crypto right now is actually not Bitcoin. And I think a lot of the innovation that I'm personally just a huge nerd for and really excited about, is outside of Bitcoin at this point. But I'd love to get from just a purely a market structure perspective, like how important is a strong Bitcoin to crypto?
Yeah, it's a great question. I think that thread. I think Jordy's an incredibly talented, smart investor. I think that thread was so off base, and I think it is so outdated. Bitcoin is a great asset. I own Bitcoin. Mark owns Bitcoin. We can both say it's going lower right now, but we both love it. It's a good asset. I think I ascribe the same 0% probability of it going to zero. Like I think Bitcoin will probably end up at $500,000 or $1 million a coin. I really do. But in that process of going up as much as I think it will go up, Bitcoin dominance will go towards zero, regardless, right? And by definition, it's almost like if you ever bet on golf, right? Do you want to take Tiger Woods or do you want to take the field? Tiger Woods might be great, but guess what? The field is going to win more times than not. The field is growing faster than Bitcoin. There's going to be every single company in the world is going to have a token in the future, from Starbucks to United Airlines to Netflix. Every municipality is going to have a token instead of revenue bonds and go bonds. Every university is going to have a token instead of donors and boosters. You're going to have a token that can be redeemed for tuition one day. The field is growing so fast in terms of token issuers that Bitcoin dominance is going away. The term altcoin is going away. And Bitcoin's as a driver of digital assets is going away. It doesn't make Bitcoin a bad market or bad asset, but you used to have to go through Bitcoin, right? If you were trying to get money from the traditional banks and brokerages pipes into digital assets, you had to go through Bitcoin, right? That was the starting point. There isn't a single digital asset investor who's been around for longer than 2 years that didn't have to go through Bitcoin first to get into this market at some point. That is now not the case, right? You can allocate directly into ETPs of other assets. You can go into stable coins. You can directly allocate into venture or liquid hedge funds. There are so many different paths now. You could start playing a video. You can play a game and play to earn, and you can farm. I mean, there's so many different ways to get exposure to digital assets right now that don't involve going through Bitcoin. That in short periods of time, when Bitcoin goes down, other assets will go down, but over longer time periods, it just doesn't matter anymore. And you've been seeing it for 2 years. I mean, let's look at literally just 1 year returns from January 21st to today. Bitcoin is basically flat, right? All of Bitcoin's gains last year came in the first 3 weeks of the year, and Bitcoin's done nothing since. DeFi is down 30 to 60%. It's been in a bear market for over a year. Protocols, layer one protocols, are up anywhere from 100 to 500%, right? From Ethereum being the 100%ish, and your Solanas, Avalanches, Phantoms, Nears, Terra Lunas, etc., being up way more. And of course, gaming and NFTs have been in a stratosphere. And Web3 is completely mixed because Web3 is kind of a catch-all generic term, and it's probably needs to be broken down further. We've already seen that dispersion, and it's had nothing to do with the fact that Bitcoin was a roller coaster all year last year. So I think it's just, we have to start treating digital assets the same way we treat ETFs, which again is, just because something is packaged inside an ETF doesn't make them the same. What's inside the ETF wrapper is what represents the value. And the same thing is now true of digital assets. Just because something is wrapped in a blockchain-based wrapper, which makes it a digital asset, doesn't mean that it is the same asset. And the reason we get these high correlations and these high, leveraged dumps and stuff like that is not because of the assets themselves. It's because of who owns them, right? If you go back to the beginning of last year, when Bill Wang at Arca Capital was dumping everything, most of those stocks historically had very little correlation to each other. But what happened when one guy sold them all at the same time? All of a sudden, the correlation went up.
Yeah, right.
The same thing is now true in digital assets, because we still have the same market makers making markets in everything, and the same exchanges trading everything, and the same investors trading everything, that when, to Mark's point, you get one of these cascading liquidations, they all move together on the way down. And same thing on the way up, right? When you get a cascading liquidation on the way up, or all of a sudden there's more buyers than sellers and market makers have to take everything up together, you're going to get these short-term correlated moves. But the dispersion over any longer period of time, 6 months, 18 months, 30 months, whatever you're looking at, is going to continue, and Bitcoin is just not relevant to most investors who are looking at different pockets of this ecosystem.
Mark, what do you think?
No, again, I'm shaking I'm nodding my head. Yes. I mean, that is exactly the point. And I really don't have much to add. I'll just reiterate everything that Jeff said. But the one little thing I would add that isn't about the primary point, which is back to Jeff's point about so many pockets of value and inefficiency and opportunity. Again, totally agree. And I talk about this all the time. Winter is not a horrible thing. I like winter. right? I like going skiing. I think that you're out in the mountains right now, Michael. And I love activities in the winter. And winter does something necessary. It kills the weak stuff. And the problem, in my mind, since the global financial crisis, is globally in the West, not so much in the East, but definitely in the West, we became participation trophy economies. That everything's good and everybody wins, and it doesn't matter if you're a horrible company, we'll still give you money for zero interest. That's a bad plan. Bad companies should die. Bad projects should die. Bad coins should die, right? And I don't mean that like go out and shoot stuff randomly. I mean, if it's bad, don't prop it up. Don't let it be draining oxygen from the system and draining attention from the system. And that's where we are. In fact, some of the best investments, not some, the best investments I've ever made in my career. And Jeff is not, I'm just old, right? I've been around a long time. And the reason I've been through a lot of cycles. And 2002, right? The depth of the recession after the collapse of 2000, Amazon's down 91%. Just think about that for a second. Amazon stock down 91%. And everybody's like, you can't do venture capital in a bear market. You can't do venture capital in a recession. We invested in a venture capital fund that did a startup airline called JetBlue. We made 20 times our money. That was great. So you can do really good stuff if you find really great founders. The founder of JetBlue Airlines is a genius, mad genius. Did the same thing in Brazil with Azul. And you can find really, really talented people to back in any environment. And the nice thing about the winter is nobody else wants to go outside, right? So go outside, dig around in the snow, find a few acorns, and save them for the spring, plant them, and you make big oak trees.
It's like that little guy in Ice Age. All right, we got 10 minutes.
Exactly.
I
never thought of myself as that little guy in Ice Age.
It's exactly what we're talking about. Yeah, that's a nice visual for everyone. All right, we got 10 more minutes here, and I want to get there. I've got questions I really want to ask you guys. So when I was putting these charts together yesterday, I was just reminded about just how early we are in digital assets, because I was trying to find indexes for sectors, and I was like, Jesus Christ, none of these things exist. That's why you guys got a whole bunch of different pictures of, right? There's like the MVI, right? Shout out to Index Co-op, who's actually doing a pretty good job with this, right? There's like the MVI, the Metaverse Index, right? They've got the DPI, the DeFi Pulse Index. But in general, it was really hard to pull out distinct sectors, and there's still arguments over how we should even have different sectors in crypto. But my question for you guys is, what are some of the sectors that you think should outperform? I want to deep dive on DeFi specifically there. And then do you think the value in active management, let's say in crypto in 2022, is going to be dispersion by picking the right sector, or is it going to be by picking the right project within that sector? Because one thing that actually did surprise me a little bit, these aren't apples to apples comparisons, it's not totally fair, but when I looked at the top 5 dexes by volume, right? You have Sushi in there, you've got Uniswap, you've got Curve. And actually Curve, chart crime, right, Mark? There's this very specific moment in time, but Curve has drastically outperformed some of these other exchanges, and I know they've just done their VE thing, which is very exciting at the current moment in time. But it was pretty interesting to see, actually. Basically, in every category that I drew, there was one big outperformer. So my question to you is, do you think alpha is going to be generated by picking the right sector? If so, which sector? And then, or is it going to be done by picking the right project within each sector? It's a 3-part question. Sorry, I cannot do 1-part questions, apparently.
Sure. Well, I'm happy to start here. To start with, there's a reason why active management has destroyed passive management in digital assets, right? It's that in order to do passive, you have to have a rules-based index. To come up with a rules-based index in a market that evolves every 2 months is almost impossible. By the time you actually launch it, it's already obsolete. It'd be the equivalent of creating a tech index and then saying, we're just not going to include social media or Netflix or any of these. It's like, well, that doesn't make any sense, right? You have to evolve as the market evolves, and the passive indices, by definition, can't do that. So it has been tough to create these indexes because they just don't actually do what they're supposed to do. That won't be the case forever, right? Eventually, passive will probably outperform digital assets like it does everywhere else. But in the early '80s, active management in high yield was a big deal, right? Active management in the equity market in the late '90s, early 2000s was a big deal. the same thing. We probably got 5 to 10 years here where active management and digital assets will continue to massively outperform passive. That being said, to your point, it is very hard to figure out, well, what are these different sectors? What are these different token types? Shout out to my own marketing team. If you go to the Arca website at ar.ca, we actually did a pretty deep dive topography, basically, in terms of mapping out exactly how to think about the digital asset landscape in terms of looking at different token types and issuers and how they accrue value in sectors and things like that. It's very difficult to have a sense of where to look in this space if you don't even know the starting points. Right. So, I think that in terms of where I'm looking today, I actually think it's going to be less important to pick the individual winners, and it's going to be much more important to pick the thematic areas correctly, right? You may obviously have a winner or a loser within a sector, but it's much more important to get the overall theme right. So, for instance, what we're looking at Arca right now is, we still believe in DeFi, but not all of DeFi, right? There's pockets of DeFi we really like, which is decentralized trading and insurance. We think, given all the hacks and all the risks involved in DeFi, that having proper insurance is really important. But we're less interested in asset management, and we're less interested in lending and borrowing, just because it doesn't actually accrue the value. So I think, finding those pockets within DeFi are going to be really important. For instance, I actually think structured products is going to be really interesting 3 years from now, but not today, right? There's a variety of different reasons why tranching risk doesn't make sense today, largely because it's the opposite of the traditional world. In the traditional world, everybody wants the AAA piece and the triple B piece, and nobody wants the equity slice, and that's why the sponsors basically eat it themselves. In digital assets, it's the opposite. Everybody wants the equity slice, but nobody's there to buy the triple B or the triple A slice because nobody wants 1% to 2% yields, and there's no credit ratings to allow the insurance companies and those who care about ratings to come in. So structured products is a part of DeFi, for example, that we wouldn't be buyers of today. Similarly within, like Web3, I think generically it's hard to say I'm a Web3 buyer, but specific parts of Web3, like we're really big into data and file storage, right? Arweave has been a big investment of ours for a long time and still is. We're really big in the idea of, B2C and consumer within Web3. So things like things like Helium, for example, which is a big project and could certainly fail, but is doing a very big thing in the TMT space. We're also really interested in the digitization of sports and celebrities, right? So this idea of, the internet has connected people to their favorite favorite celebrities, favorite athletes, favorite sports teams, but there's never been a way to really connect with them in a monetary way. Well, blockchain has solved for that, right? So things, whether it's Chili's or Rally or some of the newcomers coming up, this idea of being able to directly connect the fan experience to who they care about in a monetizable way, I think that's a theme that you really want to be invested in. And again, I would say that actually, I guess the last theme that I'm really interested in is anything with rewards, right? I think this idea of rewarding your early customers is so important, right? We've seen it largely in DeFi, but now you're seeing it in gaming as well, and you're going to see it in other things. Like, for instance, there's certainly going to be a winner in the healthcare category soon, where it rewards you for doing certain healthy exercises, right? And the insurance companies will probably subsidize that. But anything that involves rewards, where you are getting paid for doing some sort of an action. I'll take a quick aside here. You remember when Facebook solved the growth story, and they said there was an easy formula to what made Facebook work. Everybody who followed 10 people or liked 10 posts was likely to be a customer for life, right? Well, you didn't get rewarded for doing that action. They were just hoping that they could get you to do that action. Well, now with blockchain, once these companies and projects figure out what it is they want you to do, you are now going to be rewarded for doing that, right? And that is the biggest difference right now between the equity market and digital assets, right? If I was an early Amazon Prime member, I got all the benefits of Amazon Prime, but I didn't benefit from Amazon's share price going up by being an early Amazon Prime member. If I'm a token holder, I do get both now. I get the benefit financially from this project working while still getting the same member benefits for being early. And that reward environment, regardless of what sector, is going to drive returns in digital assets for decades.
Yeah, look, again, the ownership era is upon us. And look, technology, the evolution has enabled so many great things, right? We're using TCP/IP right now to communicate in 3D, digital quality, HD. I still don't love that because I have a face for radio. But
Mark, Mark always says this, and then the comments of the YouTube section are like Silver Fox, Silver Fox.
Ah, you're so nice. You're so nice. But
they're in there.
But I appreciate that. But it's interesting in that technology, in Web 1, all the gains went to the pipes, the infrastructure, and the big companies, the Ciscos and the Microsofts and the Dells and the people who were getting us to have these machines that we're playing with. Then Web 2, interestingly, was really and that was a lot of wealth. I mean, there was a lot of wealth created in Web 1. Web 2, way more wealth, like orders of magnitude more wealth. And it was really about these monopolies that basically took your asset, which is your attention, your time, your photos, your likes, your whatever, your actions, and monetize them themselves by selling your data to advertisers. And pretty good business. Now, that whole transition into Web 3 is going to be orders of magnitude bigger opportunity, but the participants are going to own it. I mean, why do I use the Brave browser instead of every other browser? Well, because I get paid for my attention. I don't get paid a lot, but I get paid for my attention. And that, I say this all the time, like Best Buy, right? When I drive by Best Buy, my phone should light up. She said, "Oh, Mr. Yusko, we love you. You are our favorite. We've got all the stuff you looked at last week. It's all ready. It's boxed up. You get 15% off if you come in right now." And they should never spend $1, not $1 on advertising to me, because they don't have to, because I'm addicted to Best Buy. And there are lots of products and services like that, where whether it's Activision just got bought on Monday for $70 billion. Who won? Investors and average people, most people in their index fund, because they didn't really pay attention to it because they thought it was a shitty stock. But did the users of the games or the players of the games get any of that money? Hell no. Is that going to change? Oh my gosh, unbelievably going to change. And whether it's shout out to Gabor and Pointsville and what he's doing. Interesting project and a whole bunch of other play to earn things. This wave of innovation around participation, ownership, community, social tokens. Listening to Timbaland talk about what he's going to do with his ape, Congo, right, is amazing. Now, can there be 10,000 Bored Ape characters? Nope. Someone tried to say, well, it's like if Stan Lee came down and said, "Hey, I got these characters. Do you want to buy one?" That's what Bored Apes is. Like, no, it's not, because Wolverine is different than Spider-Man is different. You know what the number one skin in Fortnite is right now?
I don't.
Spider-Man.
Oh, really?
Spider-Man.
Really?
The crossover of that is incredible. Marvel. I remember when Marvel, right? I remember when Icon bought it and got lambasted, saying, "Oh, you spent all that money for comic books? Are you an idiot? It's the worst investment ever." They made more on the last Spider-Man movie than he paid for the whole company 20 plus years ago.
He's looking pretty smart now.
One movie.
Yeah.
But I don't think the Bored Apes are different enough that they can each have their own ecosystem, like a Spider-Man or like a Wolverine or like a Captain America. But we love characters. People love characters. People love storytelling. They love content. And look, the reality is, this is not necessarily a good thing. We are becoming a global society of entertainers. Right? We don't make stuff. We entertain each other, right? We go out to restaurants, we go to movies, we play video games, we listen to podcasts, we entertain each other. And that's cool to a point. It's cool to a point. But somebody has to make the protocols and the projects and the rails on which the rest of us create. And the fact that 35% of my son's generation, the 11-year-olds, want to be a YouTube influencer, that's their goal in life. 35%. 1 out of 3 kids, that's their goal. They want to be that kid that unboxes toys and made $26 million. I mean, are you kidding me?
Well, that doesn't sound bad.
$26 million?
That sounds pretty good to me. I see why they want to do it. I will tell you, guys, I know we're out of time here. I really wish we had, one day, Mark, you and I will get enough time to go through the stories, but just everything that's...
I know. We never
I'm going to stop even saying that because we never get to it, but...
Well, and especially when we have a guest like Jeff, who I could listen to all day.
Jeff, this was great, man, having you on. But I would have loved to get your opinion on just like the whole corporate-verse thing that's happening. I mean, Facebook, moving in, and I mean, I don't know if you guys saw their NFT announcement and everything. I'm with you on that, man. 18 months, biggest villain in crypto.
The idea that a metaverse or the metaverse, the idea that the metaverse will be owned by any one corporation or it'll be a place. The metaverse is a point in time where your digital life and your real life come together. And it will be transcendent, this is not the Microsoft intranet. The internet is better. The metaverse is better.
I'm with you, but don't you think Zuck doesn't feel like that? If I was sitting in Zuck's shoes, I wouldn't feel like that. I'd be like, there are 20,000 devs in all of crypto in general. My company, the market cap of my company is comparable to this entire asset class. I've got 3 billion users. I am the metaverse. That's how I think.
Of course he thinks that.
I was Zuck.
Of course he thinks that. And more power to him for thinking that. But
I mean, look, there was never meant to be one singular metaverse, right? The whole premise of metaverse, which is actually, I believe it's a sci-fi term from a 1992 novel called Snow Crash, which obviously, as a result, leads to ambiguous definitions of what metaverse is. But the whole idea of it is that it's an interoperable digital economy between multiple social networks. Mm-hmm. So trying to pigeonhole this entire economy into one metaverse creates an unnecessary consolidated point of failure, which is the exact opposite of what we're going for Web 3.0. So you might see some consolidation, you might see more corporate brands getting in and stuff like that. But the reality is, you're going to have a lot of different metaverses, and it's going to be a seamless experience going between them. It's not going to be one place where you go. I mean, that is completely against the entire ethos and spirit of what is trying to be built here and what this technology is actually for. So I think on the positive side, the rebrand of Facebook to Meta was a big boon for awareness. Mm-hmm. It's going to bring a lot of investment dollar in. It's going to bring a lot of corporate brands in, influencers, analyst companies, et cetera. But a centralized Web 2 version of a metaverse is just not offering the same kind of advancement of what we can do in more of a creator economy, Web 3 type economy. So I think for me, what's really exciting about this entire theme is that instead of building on top of old rails, which just masks the problem, we're actually building completely new rails. And as a result, you're going to have a lot more experimentation, a lot more cool things happen than what a corporate entity with a board of directors and shareholders and is allowed. For example, you'll never see Meta put a casino into their metaverse, right? That's just a line that they won't cross. Well, you're going to see tons of casinos popping up everywhere else. So I think these decentralized metaverses and multiple metaverses on these new Web3 rails are going to have permanent and undeniable advantages to their counterparts just because they're not beholden to pre-existing structures.
I'm with you, by the way, guys. I completely agree. I'm just trying to put myself in the shoes of how, honestly, I would be thinking as Mark Zuckerberg. And what his, just astounded me, frankly, is the amount of, positive sentiment. I saw his tweet, Instagram has rolled out NFTs or Facebook. We've won. It's I don't know, man. I don't see it as being, I see it as being, I agree. I think Facebook rebranding themselves as Meta, that's firing the opening shot, just like they did with Libra and stablecoins, frankly. Mark, you and I have talked about this before. They announced Libra and stablecoins were at $4 billion in market cap. And, 18 months later, they're at $140 billion. And I'm not saying that was all because of Facebook, but they certainly fired the opening shot. Guys, we're already over time here. Thank you so much. This was, we didn't get to any of our stories, but honestly, you've given me a lot to think about. Whenever you see me going like this, that's just me thinking about what you guys are saying. So thanks, Jeff, for coming on. This was a ton of fun. And Mark, favorite hour of my week, man. Every single week.
The same. Yeah. Thank you. Jeff,
Absolutely.
Thank you.
Yeah, Mark, great speaking to you again. Michael, thanks again.
Absolutely, guys. Thanks.